So another important procedure here is the assessment of the risk of material misstatement. So take note that this is the heart of our risk-based audit process. Our reference for this part of our discussion is PSA 315. So understanding the entity and its environment and assessing the risk of material misstatement. Our objective here is that we are required to identify and assess the risk of material misstatements. One is at the financial statements level and another is on the assertions level. So when we say financial statements level, that means that we have to consider the risk arising from the environment upon which the financial statements are prepared. So meaning to say, when we say financial statements level, we are not yet looking on the specific item inside the financial statements, but rather the environment surrounding the preparation or the process of the preparation of the financial statements. So that is why at this level, we assess the risk coming from, for example, integrity of the client, volatility of their business, so the process behind the preparation of the financial statements of our clients. And when we say assertion level, so this is the time that we look at the quality of the account of our client, the nature of the account of the client, the specific financial statement items themselves. Now, in assessing the risk of material misstatements, what is important here is for us to develop our appropriate responses to this assessed risk. So here, I'll have a summary of the risk that we will be going to assess in our planning as well as our relevant response. So for example, for inherent risk, so remember this is the risk that arises from the very nature of the items in the financial statements themselves. So even without the intervention of control. So that is why to identify this inherent risk, we perform our risk assessment procedures, our understanding of the business of our client. And then for control risk, so these are the risks that arise from the failure of the internal control of the client. So that is why we need to perform study and evaluation of internal controls as well as test of controls when warranted by circumstances. And finally, we have the detection risk. So this is the risk that the auditor will not be able to detect the material misstatements in the financial statement. That is why here, our response would be to perform substantive audit procedure. So this is the summary of the whole risk assessment procedure and further audit procedures that we will be performing in an audit engagement. So this process is sometimes illustrated by this one, by funnel like analogy, wherein the risk will be filtered. So sometimes in other auditing literature or references, instead of funnel, it would be a filter. So what happens is that this risk or these risks are the contributor of the audit risk, and the funnel or the filter are our procedures. Our objective is to reduce the audit risk as low as possible. However, at the end of the day, we cannot reduce the risk to zero. So that is why the illustration is a funnel or a filter, because there will still be a residual risk that will remain after we have instituted our responses. So the residual audit risk is something that we should be able to accept, that at a level that we have to be able to accept. So acceptably low level. So despite performance or designing several responses to address the different risks that could affect the financial statements of our client, there will still be residual risks that remain. But what is important is that it is at a level that is acceptable to us. So let us discuss one by one. So the specific procedures that will go on these specific responses of the auditor. So here are the steps in the assessing the risk of material misstatements in the financial statements of our client. So the first is to identify the risk by considering our client's environment, their business, their internal controls, the class of transactions and account balance and disclosures contained in their financial statements. So after we have understanding of this item, then we can express our assessment in terms of numbers like percentage. For example, a risk can be expressed, let's say, in a 100% risk or 75% risk or 50% risk. So that is quantitative assessment. Or we can also do our assessment on a qualitative basis. Like for example, high risk, moderate risk, or low risk. And then after identifying the risk and the financial statements of our client, we relate them to what can go wrong at the assertion level. So meaning to say, how could this risk translate to misstatements in the financial statements? So for example, let's say there is a risk on the client not evaluating their credit customers properly or appropriately. So what can go wrong? So in that case, their receivable might not be collected in the end. So that is the WCGW in connection with that particular risk. So we have to relate the risk into its possible effects on the financial statements of our client. So that is what we call WCGW, or what can go wrong. And then finally, we consider the significance and the likelihood of the risk, the magnitude of the risk. So how material can it affect the financial statements? How pervasive can it affect the financial statements? Because remember, end of day in our risk-based audit process, we have to prioritize. So we have to prioritize those areas which could lead to higher risk of material misstatement. So in this case, we can prepare some sort of a matrix, so which would help us identify which of the following risks in terms of significance and likelihood would most likely affect the financial statements of our clients. So basically, this is the step that we adopt in assessing the risk of material misstatements of our clients' financial statements. Now we go to the first one, assessing the risk at the financial statements level. So remember, when we say financial statements level, we are not yet looking at the specific item in the financial statements, but on the environment, on the process, on how the financial statements are prepared. So at this point, we have to look at the integrity of the management, because it could affect the preparation of the financial statements. Now, the experience and the competence of the management and those in charge with governance, like the audit committee. So we also have to consider the motivations of the management, their KPIs or key performance indicators. So what would push them, for example, to manipulate or misrepresent the financial statements? We also should look at the nature of their business, the volatility of their business, and finally, industry factors. So these are the factors that can affect the environment on which the financial statements are prepared. Okay, and based on our assessment, we will develop our responses. So for example, of responses at the financial statements level. So let's say there's a question about the management integrity. Then we have to remind the team that we have to increase our professional skepticism at all times. So because we have this indicator that some management personnel so might not or might be comfortable in performing misrepresentation. So we have to increase our skepticism at that point. Or in the nature of the entity's business is quite technical, difficult, complex, then the response on our part would be to put uh, more capable or competent audit team member, such as an expert, to address that complexity from their business. So what is important here is that we have to identify the possible risk arising from any of this area for us to develop our appropriate response. And then we have to also assess the risk not only on the financial statement level, but also on the assertion level. So here on the assertion level, we have to consider FS line items or financial statement line items that are more prone to material misstatement. So like for example, those involving judgment like impairment loss. So impairment loss, so that would require a lot of judgment, and normally the amount is material. So we have to consider that whenever the client report that item in their financial statements. Now, another is the complexity of the transaction. For example, those involving, let's say, investments or derivatives. Okay, so those items no that could result to misstatement because of the complexity of their nature. So we have to consider that. So those items that are susceptible to misappropriation, like for example, cash or high valued inventory. So we have to put particular focus on that. So transactions occurring near period end because it's an opportunity of the client to, let's say, reach a certain KPI or target. So we have to consider that also. And those transactions that are not subjected to ordinary processing. So similar to the one that we have discussed earlier, those involving significant judgment. So in this case, our responses would be, for example, to increase the amount of procedure or evidence that we have to obtain on that particular item as a response to that identified risk occurring at the assertion level. Okay? Next, we have the assessment of the control risk. So in our risk assessment procedure, we consider both inherent risk and control risk. No? Not only the inherent risk existing in our client's business. So in fact, in some audits, we can perform combined risk assessment. So meaning we assess inherent and control risk at the same time. Okay. So in this case, we make our preliminary assessment of the control risk on our client and identify significant classes of transactions. So subjected to the controls or process of the client, and we assess whether those controls are reliable or not. So because our assumption is that the more reliable the internal control system is, then the less the material misstatements could come from that particular area, and therefore we can reduce the work on that particular area. So that's how we use our assessment of control risk in audit. Okay. However, we will discuss in detail this part of our procedure when we go to study and evaluation of internal control. So what is important at this point is that we know how this fits in our overall strategy, how assessment of control risk fits in our strategy in approaching our audit engagement.